Most investors focus on yield, but after ranking dozens of income ETFs using my DRIP score and income versus NAV decay ratio, I discovered that some of the highest yielding funds were among the worst performers in the entire study. Today, we're counting down the rankings from the bottom all the way to the top, and the number one ETF wasn't even close. So stay tuned. Welcome back to Simply Money. Over the last several months, I've been building the Simply Money DRIP score and income versus NAV decay ratio. The goal wasn't to find the ETF with the highest yield. The goal was to find the ETFs that did the best job converting income into long-term wealth. Today, we'll look at the biggest disappointments, the biggest surprises, and the ETFs that dominated the rankings. Before we do that, let me explain the sheet. We'll go over it real quick. Then we'll dive into the tiers, and I've ranked them into 5 different tiers. So what we have here is the Simply Money DRIP score with income versus decay ratio. On this sheet, you'll see that each and every one of these tabs down here is a separate DRIP sheet. If you've watched my videos before, the all-in scenarios, you can check them out on the playlist up above. I take individual funds and I look at the different scenarios. What would it look like if we dripped? Did 50% drip or 0 drip. But what I did on this sheet is I've combined all of those into one, and then we have a summary sheet that scores them. So we can see which ones are actually producing total return, which ones are great for income, which ones are great for reinvesting. And we can look at all these different factors, and we have a summary chart for all of it right here. On the summary chart, you'll see the ticker symbol down the left-hand column here. As you'll see, we have about 81 on here currently. And this is a live updating, so you might see some of these numbers changing as things are updating on the market and the live feeds in the back. But what we've done is we have the ticker symbols, and then you have the fund name, and from the dates that we set on these individual tickers, so we'll look at this one here just to give you an overview. You have the date that we're starting from, the share price on that date, when it pays, whether weekly, quarterly, monthly, what the symbol is for the ticker, and we're looking at on this sheet a $50,000 investment and how many shares it would have bought you. Then each time it pays a distribution, it updates the date, updates the share price, and updates the dividend amount, and then shows you what you're getting paid, whether you're doing drip, 50% drip, or full drip, and it calculates all that for you, and it pulls all of this over onto the summary tab. The summary tab is showing us the price appreciation from that start date. All of these are based on the start date. So if you want to go in, I have them from as far back as I could pull data on each of these. So some of them are obviously very new funds and others are older. We're doing a from inception type of comparison. Then you have your total return if you drip, your total return if you did 50% drip, your total return if you did no drip, your yield on cost with full drip, 50% drip, and no drip. So you're seeing what the yield on cost is actually becoming, what the average yield is. And then over here, we have our drip score and our income versus decay ratio. And so what I've done is I have them all listed here. They're listed alphabetically, but I'm going to go ahead and we're going to rank these. And I'm going to give you the rankings of where they fall with a short explanation on that. So stay tuned, because Tier 1 is where you're going to want to see some of these high scores and which ones really dominated in this. The drip score is telling us, is it better to drip or is it better to take the cash? Because some funds, you actually get a better total return if you take the cash. And knowing that is important, because if I'm dripping, but I could actually make a greater return by taking the cash and then redeploying it somewhere else, I want to do that. But if I don't need the income and I want to reinvest it, it lets me know how much greater return is it getting by dripping. And on this one, for example, the green means that you're getting a 13.39% greater return by dripping than if you don't drip. If it's negative, it means you're actually making more if you don't drip. So we want to look at that, and that gives us the real quick indicator on those. Then the second thing we're scoring is the income versus decay ratio. Because some funds, the decay is there. You're going to have the NAV decaying, and that is okay. It's not always bad. You have to watch it. You want to monitor it. If the decay is not as rapid as the income, even though the NAV is going down, the income is outpacing it, and you're still making a positive, strong total return, and that's okay. And some funds work that way, and you just have to be aware of it. Then you have other funds where the NAV is decaying, the income's not keeping up, and that ratio's out of whack, and that's where we get into the red on this column. And then we have the purple, which is simply there's no NAV decay. It's actually produced a positive return. We're going to set these up in the tiers. We're going to start with tier number 5, failed the drip test. These ETFs generated income, but investors paid a heavy price in total return and capital preservation. Tier number 5, coming in at the bottom, is YQQQ. The yield looked attractive, but the combination of weak total return and capital erosion pushed it toward the bottom of the rankings. Let's go ahead and look at this one on the sheet. We won't go into all of them individually. We'll be here all day. You can feel free to look at the sheet yourself. But as you can see, the price appreciation is negative 49%. Which isn't in of itself necessarily bad. We have funds that the appreciation is negative, but it still had positive total return, and we'll look at some of those. But you can see that this total return is negative. What the score shows you is that it actually did better by taking the cash, but it's still negative, and that's where people have to be careful. They say, oh, you do better by not dripping. Take the cash and reinvest it. You're still getting a negative return, which means you're just simply getting your capital back. And I want to clarify, return on capital is not always your capital. They do that for tax purposes, but for others, it actually is your capital. And that's where this type of scoring can help you differentiate something like JEPI, which if you've followed the channel, you understand JEPI has had a phenomenal year. It's positive, like 75% appreciation, and it's producing a 35% yield. It has just crushed it, and they are using return of capital on a lot of that to reduce your tax burden. So if you have that in a brokerage account that's not tax advantaged, it can help you out. Just because it's labeled ROC doesn't necessarily make it bad. And that's where this type of scoring helps us see, is it actually returning our capital? And why QQQ? Yes, it returned our capital. It shows that you did better, but you still lost. You didn't lose as much by taking the cash, but you still lost. And then your decay ratio is your 0.76. It's in the red, meaning that you're decaying the NAV faster than the income is producing, and that is a negative decay, and we don't want that. So that is what it looks like on the chart as we're ranking these. Then we have SALTY, SLTY. It produced income, but the underlying wealth creation just wasn't there. This is a perfect example of why yield alone can be misleading. Coming in on tier 5 as well, NEHI, N-E-H-I. It struggled under the drip score framework. High income doesn't automatically translate into successful long-term investing. Now here's the interesting part. The next tier contains several ETFs that many investors actually own today. Tier 4 is what we're calling the yield trap warning zone. We have coming in this tier, we have MISTY, M-S-T-Y. Big income, big excitement. Unfortunately, the total return numbers tell a very different story. Let's take a look at MISTY as an example of tier 4. Right here we have MISTY, negative 79% on the price appreciation. Total return, negative, negative, negative. Although you're getting this huge 84% yield, you're getting better return by taking the cash. Again, it's a better return. It's not as big of a loss. It's still a loss. But our income to decay ratio is in the yellow, meaning it's borderline. It's not necessarily horrible. It's on the borderline. Maybe something to keep an eye on. And if you change time frames, this might change. It might go green, it might go red if we played around with different time frames. And that's the other thing. When you go to the individual sheets down at the tab and you update and change the starting dates, this will update because different periods perform better or worse. So that is an example of a tier 4 fund and how it did. In tier 4, we also have CONY, C-O-N-Y, one of the most talked about income ETFs online. Yet the drip score suggests investors may be sacrificing more wealth than they realize. Another one is ULTI with an I, ULTI, huge income generation, but long-term results have been difficult to justify. And also in Tier 4, we have BTCI. This one surprised me. The distribution looked solid, but the overall performance simply didn't keep pace. So that's Tier 4. At this point, we've eliminated many of the ultra-high yield funds, but now we start getting into the ETFs that actually delivered respectable outcomes. Tier number 3, income with trade-offs. Starting this tier off, we have OARK. This was one of the most fascinating results. Some strong income, respectable total return, but significant NAV decay. Let's take a look at this one on the chart. OARK. Right here we have it. Negative 64% NAV depreciation. But your total return, 70%. You still received a total return in the positive. If you dripped half of it, total return positive. If you took the cash, total return positive. So the yield is outpacing that, and that's where we have the scores here. The drip score, you did better if you took and dripped it. Taking the cash performed lower. You can see 30% total return compared to 70%. So dripping, if you're able, you're not needing the income, and this is where deciding what funds to get in can matter. Are you in the accumulation phase? Are you building up? Or are you in the I need cash phase? And this is where the score can help you out. Again, this one right now is in the yellow on the decay ratio, but it performed with a positive total return. So it gets put in Tier 3. Also in Tier 3, we have SLVO. Many investors love SLVO for the cash flow. And honestly, it performed better than some critics expected. We also have GDXY in Tier 3, a very mixed report card, great in some areas, weak in others. Then we have PLTY, one of the more interesting risk-reward profiles in the study. This one's worth taking a deeper dive into. If you're looking into it, look at that NAV and then look at the distributions. There's a special thing that happened in the distributions. I want to look at that for you because sometimes things can be a little bit deceiving on the surface. PLTY, we have a negative decay on the NAV, but we have positive returns and positive drip score and a positive income to decay ratio. But if we look at PLTY, there's something in here I want you to see. See, the income has been sharply dropping. Even with dripping, you're slowly losing some of that where we had these huge payouts up here, and this one right here is deceiving. That's throwing it off. If you were to run this from September, after this huge payout here, the results would be vastly different. So keep that in mind, because I have a question for you here in a minute. I want to run a poll to get your input on what you want next, and this is going to be one of the reasons why when you see something outlier like this and how the dates can throw it off, we're going to do some different options, and I'm going to want your opinion, so stay tuned. I need your votes on this. Let's continue with the Tier 3. We have YMAG. This one landed squarely in the middle. Not a disaster, but not elite. Now we're getting into the funds I would actually consider strong candidates for many investors. And this is where I personally like to live, in Tier 2 and Tier 1 with my investments. Tier 2, these are the strong retirement candidates. We have JEPI, JEPI. It's consistent, reliable, not flashy, exactly what many retirees want. And a lot of these names are going to be very familiar to you. We have SPYI, one of the most popular funds on the channel. Strong balance between income and capital preservation. We also have IWMI. It had a better showing than many viewers might expect. As a small cap ETF, it's done very well. Pays a nice healthy distribution and has had some slight appreciation. Then you have DGRO. It's a low yield, exceptional quality. Gives it a high score on the scorecard. Then we have GPIX, quietly becoming one of the more interesting hybrid income funds. This one's getting a lot of attention and competing with some other funds. People are deciding whether to go to GPIX or maybe stick with some of these other funds. GPIX is getting a lot of attention lately. So that is Tier 2. And we've made it to the top tier. and only a handful of ETFs earned what I would consider the elite status under the DRIP score framework. Now, I'm going to pause here to say this is not financial advice. This is for informational and educational purposes only. I created this DRIP score and income versus NAV decay ratio sheet for you to be able to use as a tool to do your own research and make your own decisions. Remember, all investments come with risk. And here we are, tier number 1, elite wealth builders. Before we get going, leave me a comment down below. Which one do you think wins? Which fund do you think is going to take the number 1 spot? I'm going to count down the top. Number 10, GPIQ. This one has done really well. Let's take a quick peek at that on the sheet for those who are wondering. We have tier 1 example here. We have GPIQ. Total return price appreciation, 1339. Full DRIP total return, 22%. 22% with 50% DRIP and 22% with no DRIP. This is why it gets a lot of great attention, because look at whether you're investing it, whether you're reinvesting it, partial, or taking the cash, it is all pretty equal. You actually did better by taking the cash, and that shows you right here. It's in the yellow. Not by a lot. Didn't do way better by taking the cash or way better by dripping, but it does show you by being yellow that it did slightly better by taking the cash. And then we have here purple, meaning that it appreciated its underlying score, its overall return. So that is why it made it in the top 10 as number 10. It's hitting for retirees, especially those looking to live off of this. You could drip it or you could take the cash, and you're doing pretty much equal based on the time frame we're looking at. So that gives it a great score. Number 9, QQQI, one of the fan favorites on the channel. A lot of people love this one. Then we have number 8, FEPI, FEPI. Number 7, we have JEPQ. What are your thoughts on these so far on the tier 1? Now we have OVL, number 6. This one's getting a lot of attention as well. I've had a lot of people requesting that. We actually have a video on the channel on this one. You can check that out where we do the drip scenario on OVL. Looking at the chart, you can see that it got a 54% price appreciation. Total return, 90% with drip, 78% with no drip. It scored on the drip score. Did better by taking and reinvesting, so it's green. And there's no depreciation. It did grow its NAV, so it got a purple. And that is how we're scoring these. Number 5, SOXY, SOXY. Coming in at number 4, one a lot of folks talk about, an old faithful DIVO, DIVO. Then we have number 3, AMDW. Now I want to pause here. We have number 2 and number 1 left. Have you cast your vote? Which one do you think is going to win? Number 1. Coming in at number 2. Now again, remember, these are based on time frames that differ. This is just the fund itself. So before we reveal number 2 and number 1, we're going to be taking a survey in a minute. I want you to be thinking about how you want to look at these and compare them in the future. But here we go with number 2, CHPY, CHPY. This may be the biggest surprise in the entire ranking. Many investors view CHPY as simply another covered call ETF. The numbers tell a very different story. Strong appreciation, strong income, outstanding drip performance. CHPY earned one of the highest rankings in the study. And let's look at that real quick. Right here, CHPY. Right here, CHPY. Look at that. Price appreciation, 83%. Total return dripping, 188%. Not dripping, even if you took the cash, your total return is 142%. And that gives it a drip score of 46%, meaning you made 46% more by dripping. And that's what these numbers tell you. Green is a positive, great, and the percentage tells you how much better it did by dripping. Red tells you did better by cash, and the percent tells you how much better. And that's a good score right there. 46% better by reinvesting with a 999 score because it had a positive outcome. All right, drum roll, please. Here we go. And at number 1, drip score with income versus NAV decay ratio score coming in number 1, SCHD. I can hear it now. I hear the pundits. I hear those who are saying, no, not SCHD. It's horrible. It's only a 3.5% yield. It is not an income. It's barely beating inflation. All of those comments, go ahead and leave them for me right now. And those who love SCHD, I hear them. They're cheering. They're part of the SCHD fan club. I hear all of that right now because I see the comments throughout the channel, and it is okay. We're going to look at why it scored number 1. And if you're watching this channel for any length of time, this result probably won't surprise you. What might surprise you is how dominant SCHD was. Despite one of the lowest yields in the ranking, SCHD absolutely crushed the competition in overall wealth creation. This combination of dividend growth, appreciation, and compounding through DRIP produced results that no other fund in the study could match. That is why it came in at number 1. And something that's on the chart that you can look at is remembering yield on cost. People don't think about that a lot. They think, oh, it's starting out at 3.5. And that's part of the problem. I'll just say it. I'm not knocking it. I own CHPY. I own some other high-yielding funds, but I also have, as you know on my channel, and I do a video every month updating, I have a huge portion of my portfolio of the income side in SCHD. And some people even said that's not even an income. It shouldn't even be in your income portfolio. But my yield on cost, the amount I invested at the beginning and how much it is yielding now is not 3.5%. In fact, if you got into SCHD back in 2011, you were getting a 3.5% yield then, roughly. But now you'd be getting around 17% yield. And it's been increasing every year since, on average by about 12%. That compounding, that CAGR, that growth of the dividend has been phenomenal. And that's why people like it, because when you go to retire and you have income, you don't want to see your income dropping. You don't want to see your income fluctuating too much. You want to see your income growing and outpacing inflation. So when you're on that fixed income, you can actually see your income and your spending power increase and not maintain or decrease. That is another great thing that people love SCHD. What are your thoughts? Give me the comments on SCHD, on the rankings, the tiers. Do you like the DRIP scores? Do you like the income versus NAV decay ratio indicators? Leave me those comments. I can make improvements on the sheet. I'm always looking at adding new features. There's something you'd like to see. One important note, these rankings use each fund's actual inception date. That means SCHD has much longer history than many newer funds like CHPY, FEPI, and several of the Yield Max products. So in the next video, we're going to level the playing field. We'll rerun the rankings using common start dates and equal timeframes to see whether SCHD still holds the crown or whether one of these newer funds can take the top spot. That question is exactly what we're going to find out next. But I need to know, not only with these funds, are there other funds you'd like to see compared and added to this chart? I can put a few more on here. If I get too many, the sheet's going to get really bogged down because there's a ton of data being pulled in on here. There's about 200 tabs on it currently, just under that. And so I have room to add a few more. I'm probably going to take a couple off. Some of them don't like being pulled, like some of the cryptocurrency. So we'll make adjustments on that. If you do end up ordering this, you like this sheet, you can get a copy down below at Buy Me a Coffee. The link's in the description below. All of our sheets are available there. But I need to know from you, what fund do you want to see? And whatever one gets the most votes, I'm going to add into the next video to do a head-to-head with SCHD and these other funds based on an equal time frame. That's it for today. Don't forget to hit that like and subscribe button. We'll see you next time on Simply Money.